What's going on? Welcome to my channel. Hold up, this is a little bit small. Okay. Oh, much better. Okay. Welcome to my channel. I am the covered call guy. My goal is to create 120,000 in annual passive income using covered call ETFs. Right now, my portfolio yields about $76,000 a year, 6.3K a month, 1.4K a week, and about $200 per day. Legal disclaimer before we start though, this content is for informational and educational purpose only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. So please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, I am just a random idiot you found on YouTube and I could be completely wrong. Now with that out the way, let's get started on a video that was requested by a comment. So if you want something, a video on it, just leave a comment and I will try to get to it. If I don't respond, leave a comment on the next video. I promise you, I'm trying to get to all the comments. As the channel grows, it's harder, right? You guys see the the comments being left. I try to give at least 30 minutes minimum per day just to sift through the comments. So if I miss you, I haven't forgot about you. It's just a lot of comments being left, so keep leaving the comments. So this was left by I can't even pronounce the first part. I mean, Invictus 6186. I'm so sorry, man. I don't know how to pronounce that. I don't even know how to pronounce this first half here, but yeah. So he wanted a deep dive on ticker symbol WEEL. Is WEEL a trap? I thought it was a typo of weak, but hey, an actual thing, and it looks pretty good. What I found interesting was that I was actually going to make a video on the WEEL strategy. And you just happen to want to deep dive on this, and ticker symbol WEEL actually used the WEEL strategy. So you know what? Knock out two birds with one stone, right? Is that the saying? Two birds with one stone. So here, that's what I'm gonna do. I'm gonna do a deep dive on WEEL. Is it a trap? We're gonna be analyzing the retail hedge fund dilemma of the WEEL strategy here. Is it better to just buy the ETF or do it yourself? All right, the retail hedge fund problem, right? So what is the Peerless option income WEEL ETF? WEEL. So WEEL is from Peerless option income. If you Google it, their website is really nice. I think it's one of the best website. I really like it. So first impression of just going onto the website and doing, reading the prospectus and just looking at the holdings, that layout is, they have really good UI. I think it's called UI, right? User interface. Just like kind of like Robinhood. Like I don't use Robinhood. I use Fidelity, but I wish every brokerage had that UI of Robinhood. And I'm looking at the website. It's already giving me a good impression. But first impression of just a website is not enough. I like it. It gives me, it kind of gives me that good visual, good vibes. But let's dig deeper. So it represents a very sophisticated attempt to democratized and institutional grade derivative strategy, right? The WEEL, option WEEL within a regular ETF structure. So if you're just learning or want to do the WEEL strategy, you know what? This ETF does it for you, right? So let's look at the headline numbers here. As of late 2025, because that's all we have right now, right? We're still early in 2026. So we're using all of 2025 year to date from 2025. About a 16.87% return. Amazing. Absolutely great job. They aim for a 12% distribution yield. It effectively captured equity upside while maintaining a double-digit income buffer during the soft landing of 2025, right? You remember that soft landing the Fed wanted? If you agree with what the government says, then this fund did a good job. All right, the hidden trade-offs, right? We talked about a little bit of good. Let's talk about a little bit of the bad, right? But beneath these numbers lie a complex path-dependent payout profile that differs fundamentally from funds like JEPI or JEPQ, right? I'm using JEPI or JEPQ because it's one of the titans. It might not be your favorite cover call ETF, but it is one of the titans. So I'm gonna use them as an example, right? So WEEL, if I'm saying it correctly, WEEL. ticker symbol WEEL, is not just an income fund. I believe it is a short volatility, long carry strategy. I will get more into that. So just based off of this, my verdict so far, it has a role if you want it as a satellite income or an alternative volatility premier in your portfolio. My conviction here is neutral, watch list if you haven't added to your portfolio yet. So I wouldn't just put it in my portfolio just yet. However, if you're about to just pull the trigger and say, you know what, I need a satellite position, sure, go ahead. I would say that's fine. How WEEL works, right? So let's talk about the actual WEEL strategy. Time risk versus path risk. Most income funds trade upside, right? That's the trade-off we as income investor cover called ETF investors, right? Capping for guaranteed yield. WEEL makes a more subtle trade. It converts time risk into path risk. Break this down into the two phases here. Phase 1, the fund sells cash secured puts to acquire the stock. Phase 2, the fund sells cover calls to liquidate them. So a little bit different here, right? You guys kind of seeing the difference here. And it's not in a cover call strategy. It's the WEEL. This is the WEEL strategy working here. All right, the V-shaped nightmare. All right, so if you don't know what the V-shape is, it's just the recovery. How often does it, how fast, how quick, how often can it recover? Is it a slow grind, a painful grind, or a sharp upward trajectory? Here's the trap. In my opinion, in a V-shaped market recovery, WEEL is structurally impaired. Why? If the fund is assigned stock during a sharp crash, like ARK drops 30%, right, it owns the asset at a loss. Second, to generate income, it must sell calls. Third, if the market rips higher, the V-shaped recovery, these calls capped the recovery, locking in losses. It creates a drag on performance for quarters, right? This is not a, I don't believe this is a monthly payout either. I think it pays quarterly, if I'm not mistaken. Fact check me on that. I believe it pays quarterly. So for us income investors, if you want pure, you're looking to get paid out from weekly to monthly, I think this is already off your list. All right, institutional view, anti-momentum, right? WEEL is anti-momentum. What do I mean by that? When it wins, it outperforms in mean-verting markets, choppy markets. When it loses, it bleeds relative value and strong unidirectional trends, right? Both crash and melt up. So those are your trade-offs there. Understand what you're buying here, right? It's essentially using the WEEL strategy. So if you understand the WEEL strategy, and it's basically, you're deciding to let a fund manager do it for you. That's, again, a personal choice now. Right, so who's buying the bus, right? Unlike passive peers like KWEB, WEEL's manager Peerless Wealth actively select strikes and expirations, right? So we have to observe the activity here. You look at the filings. When I tell you guys, always look at the prospectus, their filings, right? Follow their paper trail. As what I can find is that filings show the use of short duration options, mostly under 1 month. The benefit of this is that it avoids writing calls during oversold conditions, right? Tactical alpha. However, the risk is that manager discretion risk. Of course, is active. You got to always take that risk, right? If they misjudge a regime change, losses are magnified. So your trust is in the fund managers. Portfolio forensic, right? We always want to consider safety first. The collateral, short-term treasuries, right, is about 55% of the holdings. The holdings of 50 to 60% of assets are in UST bills maturing January 2026, this month. Implications, the fund is effectively 50% cash. This provided a massive tailwind in 2025 when rates were 4% plus, right? Well, the 2026 risk is if you're following the news, following the monetary policies, listening to the Fed, as the Fed cut rates, which they're probably going to, I mean, they are pressured to, or if the Fed doesn't cut in May 2026, when President Trump pretty much picks a new Fed chairman, which he's gonna probably pick one that is a yes man, right? He wants the rates to near zero, right? So this risk-free income floor drops. Holding that 50% in T-bills essentially pays you nothing. You have to put the money to work. When the rates were 4.5, 5.5, it was worth it. It was worth putting your money in a high yield savings account or whatever, treasury bill, whatever it was, right? Now it's essentially, the fund is going to have to make this money work, putting it to risk. All right, the volatility engine. The wheel only works if premiums are rich. Consequently, wheel forces exposure to high IV sectors, ARKK, KWEB, SMH, VXX. So just understand, it is in these. If you're a big believer in Kathy Woods, hey, this wheel ETF is for you, or just buy her ETF ARK yourself. I mean, you got to have high conviction in their holdings there, right? The critical risk is non-diversified, because majority of it is in pretty much like top 10 holdings is literally like 50-60% cash, and then pretty much this makes up the rest of the holdings right here. So something you have to look at, the holdings. All right, under the hood, right? Let's look at how they're kind of making the money, how it works, the plumbing system. Annual reports reveal high turnover, 473%. Now, I guessed it. I already knew when I was doing my when you kind of put it and I was doing my quick research, I already knew this was not for long-term hold, right? So just looking at this, right, this confirms the strategy is grinding short-term options. Observe trades here: short put, regional bank; short put from gold miners; short call on home builders, right? And my analysis there, the manager is effectively betting on means reversion in those specific sectors. Right, the Goldilocks Mirage 2025 scorecard: wheel plus 16.87, beat JEPI plus 8.36%. Why? It was the perfect environment, right? High rates plus elevated volatility without a crash. The warning, though, in a volatility compression scenario where VIX is below 12 and rates are below 3, Will's engine pretty much stalls, right? The 12% yield becomes mathematically unsustainable. I don't think they're going to be able to hold up that yield without destroying something, possibly the NAV. In my opinion, of course, I don't know how they're going to pull this off. Of course, maybe the fund managers end up picking some really good holdings. I don't know. All right, the death spiral risk, right? Of course, every single type of income ETF or stock has this death spiral risk. Will is not immune to it. What I mean by that is sequence of return risk, SORR. If Will suffers a 20% drawdown early in its life cycle, the math turns hostile, right? The trap here is that a lower asset base generates less absolute premium dollars. The result, to maintain the same cent per dollar distribution, that 12% yield, the manager must write options close to the money, which is higher risk, right? QYLD. This creates a feedback loop of NAV erosion. Basically, it's just going to continually eat itself to pay you out. All right, tax and liquidity, right? Tax nightmare: 473% turnover guarantees massive short-term capital gains. This fund, in my opinion, is toxic in a taxable brokerage account. It belongs exclusively in an IRA, or just do the will strategy yourself. Liquidity nightmare: unlike JEPI, right, ELNs or will use a clear options. Good, but liquidity is low. It just has about 30 million assets under management. It has wide bid-ask spreads of 0.63%, making it expensive to enter and exit. Remember, I always talk about this. I'm not a hater in small funds. However, you do have to consider assets under management because of the wide bid-ask spreads. Why does this matter? It may not sound like a lot to you and I when we are making these trades, buying 1, 10, 100, or even 1,000 shares at a time. When these fund managers play in the millions or billions, half a cent per call they're buying, or however, how much they're buying, it adds up. And so if they're spending an extra 10 million, they're paying $10 million over, they have to make that 10 million back. And then on top of that, is profits to give out to you. So you guys are not seeing, when I'm not seeing, but I don't think you guys are understanding that asset under management. That is why it matters. I'm not just saying, oh, don't buy it because it's under 100 million. There's good reasons, right? Over 100 million, then we're gonna start seeing, oh, they're actually becoming, they're not a small fry anymore. They actually got skin in the game. When they're under, 100 million, they're like the little grasshopper, right? They're constantly jumping away so they don't get stomped, they don't get crushed. Once they hit that $100 million mark, then they get more favorable bid as, what is the word for it? Options. In a way, like the buyer seller, they get better pricing. It's like buying wholesale, right? If for anyone who owned those drop shipping business, I've done that too. Okay, when you buy wholesale, you get cheaper price. Essentially, that's what's happening here, right? They're not going to be able to compete with JEPI or JEPQ. For example, here is not apples to apples, but I'm just letting you know, JEPQ, right? You're like, you know what? We want 1 billion of this. Compared to for this, we can only afford about 10,000. The amount there is a huge difference. They might be paying 10 cents more, per whatever amount they're paying for, and that is why. All right, small fund blues, right? Assets, like I just said that. I guess I skipped ahead, right? So assets under management is about 26.86 million. That's danger zone, right? Funds under 50 million fades has a higher chance of closure risk, right? If WEEL cannot scale to 50 to 100 million, the advisor may liquidate it to stop subsidizing operational costs, right? So 2026, if they're just losing money, just bleeding money, they're gonna close shop. Right? Nobody's going to want to invest. They're going to look at it and be like, these guys are not making money. All I'm doing is buying the shares to pay the fund managers, right? Sounds like a typical fund that you guys are well aware of. Right? Low volume at 15K shares per day means a large institutional exit could crush the bid price temporarily, and that could crush them. So what I was saying before. All right, so I'm not going to keep yapping and going on. Right, WEEL versus JEPI, the showdown, right? Select WEEL if your mandate, your thesis, your conviction is to maximize current yield over 10% and harvest high volatility. Your account, if you have tax sheltered, a market view is choppy and range bound, and you're a small allocator. You're just starting out. You're just trying to use this to kind of build up short term. You're trying to build your portfolio in a way, right? And you got to know what you're doing. Understand the WEEL strategy first. Don't buy this without not understanding what a WEEL strategy is. Okay, I can break down another WEEL strategy in another video, another 10, 15, 20 minutes. Understand what the strategy is before jumping in, because if you don't understand the strategy, then you're just buying something you don't understand. All right, so start from there first. And of course, select JEPI. This is just a comparison, right? Your mandate is equity substitution. You're defensive. Your account taxable, slightly better. Still could be tax sheltered, but you don't have to worry too much. It is more of a long-term hold, so taxable is fine. Market view is strong bull or volatility crush. Size institutional block over 5 million. I say over 5 million is you're scaling out your portfolio now, right? You're at this point you're not too worried about buying in and out. You're just scaling. You're buying a dip, and you're just adding and adding. That's what I mean by it. All right, my 2026 crystal ball. Again, guys, this is my crystal ball. This is my scenario. This is my guesstimate. I could be completely wrong. So again, I'm saying it. Do your own deep dives, your own due diligence. All right, so scenario is the Goldilocks, rates down, market up. WEEL outcome, again, I'm guessing is positive. Equity assignment gain value. Yield dips to 9 to 10%. The winner here is WEEL, high beta. Volatility crush, right? VIX is under 11. WEEL outcome, negative. Premiums evaporate. NAV drags due to cap upside. The winner here is JEPI. Scenario, a tech wreck, right? S&P drops 15%. WEEL outcome, severe loss. High concentration in ARK and SMH leads to assignment. The winner here is JEPI. Scenario is stagnation, a flat, choppy market, right? WEEL outcome, ideal. The wheel keeps spinning, right? Puts and calls expire, worthless. The winner here is WEEL. That's the sweet spot. All right, so my final verdict, right, closing it up, WEEL is a highly specialized retail hedge fund, right, product that performed exceptionally well in 2025. However, for me, the structural hurdles are real. The lack of size, right? The lack of scale, the cost. I should probably put that in the beginning, right? 0.99 expense ratio, ridiculously high. I don't think that's worth it. I think it's 0.99. It could be higher actually. I think it was higher. Why did I put 0.99? On the website it was like 1 point something. But it's at least 0.99 expense ratio. And the complexity is very, very path dependent. So for my recommendation, on top of that, I think it pays quarterly. I think it pays quarterly. I have to double check on that. I don't know why I didn't put that. That is my mistake. Hold up. I'm quite sure it pays quarterly. Please fact check me in that in the comments. And then, so that's one of the biggest reasons pay quarterly. When I saw it, I was like, it doesn't really have a position for me at least. So I'm going to pass for core allocations. It might be suitable for you only as a tactical tax sheltered satellite position. I would say you're crazy if you make it a 10%. I would say you're playing risky at 5%. I would say anything under 5% for this type of play. But if you are a wheel strategy expert, hey, maybe you guys, maybe you know more than me. But I'm okay with wheel strategy. I know how to do it myself. I'm just too lazy. That's why I buy these cover call ETFs. I'll be honest with you. But if you're a wheel strategy expert, then yeah, this might work out for you. So not for me at least. Thanks for watching. If anybody else want more deep dives, want more of my opinion, just leave a comment below. I do not forget about you. I did not forget about you. I see all the comments. I try my best to reply to everyone. I give at least 30 minutes to sift through as much comments to reply. If I don't reply, please just leave a comment in the next video asking for a deep dive on it, and I will try to reply back. And if I reply back, I got you. Don't worry about it. I will try to make a video on it. Thanks for watching, guys. Subscribe, like, and comment. As always, I appreciate all of you guys. Hope you guys are having a great 2026. I am having a great one. Thanks for supporting the channel. Thanks for watching. Catch you guys on the next.